This video will explain the specific identification method and briefly discuss the three assumed cost flow methods. Inventory is accounted for at cost and includes all expenditures necessary to acquire the goods and place them in a condition ready for sale. After a company has determined the quantity of units of ending inventory, it applies the unit cost to the quantities to determine the total cost of the ending inventory as well as the cost of goods sold. Determining ending inventory can be complicated if the units of inventory have been purchased at different times and at different prices. To determine inventory, a company must select an inventory costing method. Some of these methods entail certain cost flow assumptions. These assumptions are used to assign cost to inventory units. Specific identification method requires that companies keep records of the original cost of each individual inventory item. As its name suggests, it does not depend on a cost flow assumption. Even though computers have made it possible to specifically match goods to the actual sale, this method is rarely used. Instead of keeping track of the cost of each item sold, most companies make assumptions about which units were sold. Let's illustrate this method using a TV company. If this company purchases 3 identical TVs on different dates at cost of $700, $750, and $800, the cost of goods available for sale is $2,250. During the year, the company sold 2 TVs at $1,200 each. We need to determine which TVs are assigned to the cost of goods sold and which one remains in the ending inventory. The cost of goods sold will differ depending on which 2 TVs the company sold. If this company can positively identify which units it sold and which are still remaining in ending inventory, it can use the specific identification method. If the company sold the TVs purchased on February 3rd and May 22nd, then its cost of goods sold is $1,500, $700 plus $800. Its ending inventory is $750, which represents the March 5th purchase. Because specific identification is often impractical, companies select other cost flow methods. These methods differ from specific identification in that they assume certain cost flow assumptions. The assumptions bear no relation to the physical flow of goods. They are merely used to assign cost to inventory units. There are 3 assumed cost flow methods: first in, first out, referred to as FIFO. The second one is last in, first out, often referred to as LIFO. And the third or the final option is average cost. The first in, first out FIFO method assumes that the earliest goods purchased are the first to be sold. Under this method, the cost of the earliest goods purchased are the first to be recognized in determining cost of goods sold, regardless of which units were actually sold. Under the FIFO method, the first units in are the first units out, or sold, so these costs are assigned to the cost of goods sold. In this example, the purchase on February 3rd and March 5th are going to be assigned to the cost of goods sold. So the cost of goods sold is $1,450. Again, that's found by taking the $700, the February 3rd purchase, and adding that to the March 5th purchase of $750. The most recent purchase is assigned to ending inventory. In this example, it's the May 22nd purchase of $800. The last in, first out LIFO method assumes that the latest goods purchased are the first to be sold. Under this method, the cost of the latest goods purchased are the first to be recognized in determining cost of goods sold. LIFO assumes that the most recent purchased goods, last ones in, are sold first. So in this example, the May 22nd and the March 5th purchases would be assigned to the cost of goods sold. Again, if you take $750 and add that to $800, you arrive at $1,550. Under this method, the oldest units remain in ending inventory, so the February 3rd purchase of $700 would be assigned to ending inventory. The average cost method uses the weighted average unit cost. The formula to calculate the weighted average unit cost is the cost of goods available for sale divided by the total units available for sale. If we take the total cost of goods available for sale, which is $2,250, and divide by the total units available for sale, which is 3 TVs or 3, we'll arrive at a weighted average unit cost of $750. The cost of goods sold and the ending inventory are assigned the same weighted average cost per unit of $750. So the cost of goods sold is $1,500. Again, that's 750 multiplied by the 2 TVs that we sold. And the ending inventory is $750, which represents 1 unit or 1 TV.